Next question. The closing price of LX Ltd is 24 rupees per share on 31st of March 2019 on National Stock Exchange Limited. The price earning ratio was 6. Okay. It was found that an amount of 24 lakhs as income and an extraordinary loss of 9 lakhs were included in the books of accounts. Means we have to understand that say there is an extraordinary income of 24 lakhs and there is an extraordinary loss of an amount of 9 lakhs. The existing operation except for extraordinary items are expected to continue in future. Further, the company has launched a new product during the year with the following expectation. So we are going to launch a new product 150 minus 40 minus 34 minus 24. So there is an additional income of 52 lakhs. All these are deducted from 150. The company has 5 lakh equity shares of 10 and 1 lakh 9% preference share of 100. The price earning ratio is 6, which they already have provided here. The price earning ratio 6. Okay. Post-tax cost of capital is 10%. So the discounting rate is given. Income tax rate is only 34%. You are required to determine, there are two questions. Existing profit from the old operations and second is value of the business. So there are two questions which you are required to answer. One is the existing profit, that is say the existing profit from the operation, and the second is the valuation of the business. Please try to do answer for both the questions on your own and put your answer in the chat box. Let us see that's how to do answer. Everybody is requested to pay attention. Giving you a kind of informal explanation first of all. Dear students, we know that the price earning ratio is MPS upon EPS. So basically earning per share is equal to MPS upon price earning ratio. What is market price per share? It is 24 rupees per share. And what is the price earning ratio? It is 6. So 24 rupees per share divided by 6. That comes to 4 rupees per share. That is the way we are supposed to make the computation of first of all a simple earning per share. We have been provided with the information that the company has issued 5 lakh equity shares. So we can say something like this. Everybody is requested to pay attention. Earning before taxes minus tax is earning after tax minus preference dividend. That gives earning available to equity shareholders divided by number of shares. That will give EPS. We already found EPS is rupees 4. Okay, number of equity shares have been provided to us as 5 lakhs. So we can compute earning available to equity shareholders 20 lakhs. 20 lakhs is calculated as 5 lakhs into 4. It is after deducting the preference dividend. So we understand that the 1 lakh preference shares of rupees 100 at the rate of 9%. So we understand that the amount of the preference dividend, it is 1 lakh into 100. So it is 100 lakhs as a preferential capital. And the rate of preference dividend is provided to us as 9%. So this is an amount of 9 lakhs. So the earning after taxes must be 29 lakhs. Income tax rate is only like 34%. So based on this, we can compute the earning before taxes. So 29 lakhs divided by 1 minus 0.34. That comes to 43 lakh 93,939. into 0.34. So it is 14,93,939. This is the way earning before taxes can be found. Now we understand that so the question is providing the information. There is an extraordinary loss of 9 lakhs. And so there is an extraordinary income of 24 lakhs which have been included over here. So basically 43 lakh 93,939 minus 24 lakhs plus 9 lakhs. So 4393,939 minus 24 lakhs plus 9 lakhs. So it is 28 lakh 93,939. This is the way the revised earning before taxes can be calculated. So basically we understand that say the first part of the question says that say you are required to make the calculation of existing profit from the old operations. So the existing profit from the old operation, we can say that say it is an amount of 2893,939. That is what's the existing profit from the old operation which we are expecting to continue in future. Now listen carefully. The second part of the question says that compute value of the business. So in that case we have to understand that say this 52 lakhs is the additional earning, and further the discounting rate is provided to us 10% for the purpose of valuation. So over here 52 lakhs will be added. So that comes to 80,93,939 minus income tax rate is 34%. So that comes to 53 lakh 42,000. This is what we understand is the earning after taxes. Okay, divided by 10%. So that comes to 534.20 lakhs. This is what we understand is the value of the business. So I request all of you to write down answer along with me. The answer of the first question: existing profit from old operations. In that write down working note number 1, calculation of EPS. In that write down price earning ratio is MPS upon EPS. So EPS is equal to MPS upon price earning ratio. What is market price per share? Market price per share is rupees 24 and the price earning ratio is 6. So that comes to 4 rupees per share. That is what we understand is the EPS. Working note number 2, calculation of existing EBT. In that earning before taxes minus tax at the rate of 34%. Is earning after taxes less preference dividend? That gives earning available to equity shareholders divided by number of shares. that will give earning per share. As far as earning per share is concerned, it is 4 rupees per share. Number of equity shares are 5 lakhs. So that will give us earning available to equity shareholders, that is 20 lakhs. How this 20 lakhs is calculated? It is 4 rupees per share into 5 lakh minus preference dividend. We understand that it is 1 lakh is the number and 100 rupees is the face value. So 100 lakhs into 9%. That comes to 9 lakhs. So earning after taxes would be found as balancing figure once again. So you do backward working. That is 29 lakhs. Income tax rate is 34%. So EBT would be 29 lakhs divided by 1 minus 0.34. So use a calculator. That comes to 4393939 into 0.34. So 1493939. That is the way existing earning before taxes can be found. We'll make a box over here just to make sure that this is found as balancing figure. Okay. Now further, existing profit from old operations. In the breakdown, existing EBT minus extraordinary income plus extraordinary loss. Existing earning before taxes is 43,93,939 minus extraordinary income, an amount of 24 lakhs plus extraordinary loss of 9 lakhs. So 4393939 minus 24 lakhs plus 9 lakhs. So that comes to rupees 2893,939. That is the way the existing profit from old operations can be calculated. Now answer for the second part of the question. In that, the question says that you are required to make the calculation of value of the business. In second part of the question, we are required to make the calculation of value of business. In that, working note number 1, calculation of additional income from launch of new product. So in that, sales of the company is 150 lakhs less direct material 40 lakhs, direct labor 34 lakhs and fixed cost is 24 lakhs. So 40 plus 34 plus 24, that comes to 98 lakhs. So it is 52 lakhs. This is the additional income from the launch of the new product. Please write an answer. Next, working note number 2, or we can say that say directly value of business. In that case, existing future maintainable earning before taxes. It is an amount of rupees 2893,939. Add income from launch of new product. An amount of rupees 52 lakhs. So this is revised EBD. So 2893,939 plus 52 lakhs. So 8093,939 minus income tax at the rate of 34%. That is 27 lakh 51,939. So revise the earning after taxes. It is 53 lakh 42,000. Now this is our future maintainable profit, and the same will be discounted in present value term to calculate value of the business. So again, column number 1 is particulars and column number 2 is answer, in which we have the value of the business. As far as value of the business is concerned, it is earning divided by cost of capital. Earning is 534.2 lakhs. I'm sorry, 53.20 lakh. Sorry, 53.42 lakhs divided by 0.10. That is 534.2 lakhs. That is the way we have a kind of the valuation of the business. Now friends, importantly over here we understand that say this cost of capital is provided to us as weighted average cost of capital. So it includes the effect of the equity shares as well as the preference shares. And with that say we are having such as discounting rate. Valuation of the business means valuation of all long-term sources of finance taken together. It includes not only the equity shares, but it includes even the preference shares, debentures, any long-term loan. Just a small note for the answer. We understand that valuation of business is based on present value of future earning, comma, discounted at the rate of cost of capital. This is what we understand. So, small summary of the entire answer. In the first part of the question, we are required to find the existing profit from the old operations. In that, say, first of all, we make the computation of the earning per share using MPS and price earning ratio. Then existing EBT is calculated. Just a small point for which you need to be careful is that when you multiply EPS with the number of shares, you get earning available to equity shareholders and not earning after taxes. So you have to add back preference dividend to make the calculation of the earning after taxes. That is 20 lakhs plus 9 lakhs. This is what you are supposed to do. Income tax and then EBT. For EBT, it is earning after taxes divided by 1 minus tax rate. That is what you are supposed to do. Then existing profit from old operation is very simple. Existing EBT minus the extraordinary income which we are not going to receive in future plus extraordinary loss which we are not going to incur in future. Valuation of the business, in that say the from the launch of the new product, the additional income and the existing profit from the old operation, both of them are considered. It is converted into post tax and there is no need to write this income tax. A smart student like you may compute directly 66%. For this value is also acceptable. Then the earning divided by cost of capital is the valuation of the business.